Welcome back to our weekly explainer. I'm your senior market strategist, and today we're tearing down exactly how, and more importantly, why, the global markets move the way they did this week. If you want to understand the true pulse of the global economy, you have to cut through the noise and look straight at the data, and that is exactly what we're going to do right now.
Here is our roadmap for today. We'll start at the week starting line, cover that midweek pullback, dig into how commodities are driving the tension, check in on tech, energy, and banking, look at crypto versus safe havens, and wrap up with our Friday market outlook.
All right, part one, the week's starting line, navigating cautious optimism.
So looking at how things kicked off, it definitely wasn't a straight line. We actually started with this wave of cautious optimism as everyone was digesting the latest inflation data. But tracking the momentum, by Wednesday that shifted into a noticeable pullback before finally settling into a sort of cautious holding pattern by Thursday's close.
Now, despite all the global uncertainty, our major indices actually stayed incredibly range-bound. Take the S&P 500. It stayed boxed in between 5,100 and 5,250. The Dow held its ground around 38,000 to 39,000. Over in Europe, the FTSE 100 showed some serious resilience, hovering right up to 8,200. And the Nikkei 225 kept in that 38,000 to 39,500 zone. Honestly, it felt like the global markets were just collectively holding their breath.
Moving on to part two, the midweek market pullback, where the mood really shifts. Right, so hitting midweek, that early optimism ran face first into a reality check. And it really comes down to two heavy hitters, persistent inflation and central bank policies. These twin concerns completely threw a wet blanket on the market's initial enthusiasm. You know how it goes. When folks start thinking central banks are going to keep interest rates higher for longer, just to fight off price hikes, they yank their risk right off the table.
And just for any newer investors tuning into this explainer, let's nail down exactly what we mean here. Think of inflation as a stealth tax on your purchasing power. It's just the general price of goods and services creeping up over time. Right now, it's literally the single biggest force dictating what central banks do. Because when inflation runs hot, borrowing money gets more expensive, and that puts a hard brake on market growth.
Which brings us to section 3, commodities driving the tension. Let's dig into the why here.
So what's actually fueling this inflation? Look no further than crude oil. It was a massive driver this entire week, trading really strongly between $78 and $85 a barrel. And why does this matter to us? Because literally everything we consume, even getting the beans for your morning coffee, takes energy to produce and ship. That strength in oil prices feeds directly into those global inflation pressures.
But oil didn't just jump up out of nowhere. It's climbing strictly because of mounting supply concerns, some very real shipping route risks, and ongoing geopolitical tensions. When the physical sea routes that move the world's oil are threatened, the market bakes a risk premium right into the price. And that premium? That is exactly what everyday consumers, and by extension the stock market, are feeling right now.
All right, part 4, tech, energy, and banking. Let's do a quick sector cross-section.
Looking at where we stood by Thursday's close, we saw this really fascinating split. On one side, tech stocks kept driving a ton of volatility over on the Nasdaq, keeping things bouncing between 15,800 and 16,300. But on the flip side, energy stocks, riding high on those oil prices we just talked about, actually acted as a massive pillar of support for European markets, keeping the FTSE 100 super resilient. Meanwhile, the banking sector was kind of all over the place. We saw very mixed performance globally, with absolutely no clear directional trend. It totally reflects the sheer uncertainty out there about what central banks are actually going to do next with interest rates. And zooming out to Asia, the Nikkei 225 essentially mirrored that broader global sentiment. The big thing to watch here were the export-driven companies. They were reacting directly to shifting currency values and what people expect from global demand. Look, if global demand cools down because of inflation, those exporters are usually the first ones to feel the pinch.
Let's pivot to section 5, crypto and safe havens. It's all about seeking shelter.
With stocks pulling back during the midweek slump, where did all that investor capital actually go? Well, when anxiety spikes, money runs to what we call a safe haven asset. Think of it as a financial storm shelter, an asset that's expected to hold its value or even go up when the rest of the market gets turbulent.
And man, did gold play that role perfectly this week. It showed incredible strength, trading in this really tight pocket between $22.50 and $23.50. Silver also held the line around $26 to $28. It's a classic move. When people get spooked by inflation and shaky equities, they park their cash in gold. And the numbers prove they did exactly that.
On the flip side, major cryptocurrencies were definitely not a storm shelter. Bitcoin was bouncing wildly between $60,000 and $68,000, and Ethereum was swinging between $2,800 and $3,400. What's the real takeaway here? These massive swings were driven purely by short-term sentiment and liquidity. It just proves that crypto is still very much the market's roller coaster, rather than a reliable safe haven grounded in fundamental economic data.
Finally, Section 6, the Friday Market Outlook. Where we go from here?
So, bringing it all together, our outlook heading into Friday is pretty straightforward. We expect the broader markets to stay strictly range-bound. Since there isn't one massive, undeniable trend overriding these inflation fears right now, the markets are going to be hypersensitive to any new economic data releases. Literally, every data point is going to be put under a microscope, meaning day-to-day investor sentiment is going to be doing the heavy lifting here. Ultimately, with inflation stubbornly hanging around, energy prices staying hot, and central banks watching everything like hawks, here is the big question you need to take away from this explainer. What specific piece of economic data is finally going to be the spark that blows this range-bound market wide open? Keep a close eye on the data this week, and I'll see you in our next explainer.